Hello, good morning. Firstly, thank you very much for attending the PSG Asset Management Outlook today. Really appreciate it, and I must say I bumped into quite a lot of familiar faces, and it's really nice seeing all of you here again in 2023. Just before I start, just 1 or 2 house rules, I think most important, just in terms of cell phones. If you can just make sure it's put on silence. Then we have applied for CPD credits, and you will receive an email from PSG shortly. Before I'm going to hand over to our 2 fund managers today, I just want to put up a graph of the S&P. And I actually just thought, when I saw their presentation, and I looked at market cycles, recency bias, and I just thought to myself, the last 25 years, I know we're all going to have like numerous examples of what have happened and clients and all of that stuff. And then I just thought, I remember the 90s, and we all know how the 90s actually ended. In 1990, I remember I was at varsity, and the rand was at R2.50 against the dollar. And after the massive run that we've had here in December 2001, the rand actually peaked here in the region of about 11 rand. And I remember when I still started like in the industry itself, back in the late 90s, we sold guaranteed products. And then with a rand that weakened so fast, I think you're still going to remember that clients actually wanted a dollar guarantee. A rand guarantee wasn't good enough anymore. And then in the early 2000s, those products started maturing. And obviously there was a lot of clients that wasn't too happy when those policies started maturing. So I actually remembered bumping into an advisor in Namibia as well, in Windhoek. And he actually said they went to the farmers there and they said, this policy, we're going to call this one your Toyota Bakkie policy. He says, and by the time that it matured, they could hardly afford the BF Goodrich tires. And if you actually just go like a couple of years forward, here in 2006, 7, 8, when the rand actually started strengthening again, do you remember how difficult it was actually going to a client and saying, you know what, now is a good opportunity to actually invest offshore? Because the only thing that the clients actually remembered was their return the last 10 years with recency bias, and they didn't want to know anything about it. So I think there's a lot of you that will be sitting here that remember how difficult it was to actually convince a client to invest offshore. Then just to take a little bit forward the last 12 years, I think we all know what happened the last 12 years and what have actually worked well. I think the one thing that I just want to show there is, if you look at the S&P the last 2 years, we've started seeing like a little bit of a blip in terms of performance numbers. Then from PSG Asset Management side, we're just asking the question, maybe we've actually started seeing an inflection point in the market. And what have actually worked over the previous 10, 12 years might not actually be the same sectors or shares that's going to work for the foreseeable future or for the next 10 years going forward. And then just to bring it back in 2010, over that period, the one thing that would have saved you would have been diversification and having a well-diversified portfolio. And I think the question that we just want to ask as well is, even if you look at your clients' portfolios currently, do you have a well-diversified portfolio? And do you have managers that are actually differently positioned and that can actually help you through if the period is slightly different compared to the past? But I'm going to leave that up to our 2 portfolio managers. They're going to go into it in a lot of detail. Our 2 managers today is Dirk Jooste. Dirk is the lead fund manager on the PSG Enhanced Interest Fund and also the co-fund manager of the PSG Stable Fund. And then we've also got Justin Floor. I think those of you that actually delved into the Alan Gray webinar yesterday would have already had like a bit of at the opportunity to listen to Justin. Justin is head of equities at PSG and is also the lead fund manager of the PSG Balance Fund. But without further ado, I'm now going to hand over to Justin. Thank you.
All right, thank you, Charles. That was a great intro. Thanks, everybody. Thanks for being here. I think we're very conscious of the fact that this time of year, you've probably had 20, 30, 40 invites to these type of outlooks. So yeah, we don't take it for granted that you've chosen to be here with us this morning, and we hope to make it your while. You know, this is our outlook when we look forward. One of the things that we're always asked to do at this point in time is give predictions. And there's always a danger in that. I think we actually not too sure about a lot of the future, but the one thing that I think we do know is there's probably a lot of meetings in all of our lives going forward. I think, especially post-COVID, that's probably accelerated, some digital, some in person. Many of you are going through that process now with your end clients, the really important people in our industry. And hopefully, if we do our job right today, just give you a bit of a sense of how we're thinking about some of the challenges about investing in this type of market. So hopefully it'll be worth your while. A good place to start is a question that's been on everybody's minds more recently, and it's a bit of a shorter term issue. It's the big R word. Are we going into a recession? Is economic growth slowing, and what does it mean? So no one really knows. I think there's different theories about when it could come. I think a recession is definitely imminent, in the sense that it's going to come at some point. That always happens. It's a classic part of how cycles work. But it could be near-dated, it could happen further away, it could be a soft landing, it could be a hard landing. And then the way that asset prices could respond to that is also very uncertain. So nobody really knows, and at PSG we don't spend too much time trying to think about some of the short-term dynamics like this. But it is quite interesting looking at this chart, and some of you might find this useful. It's a Bank of America fund manager survey. And the dark blue line just shows you basically how concerned the average asset manager out there is about the economy. And there's always an inflection point. When the asset managers get the most pessimistic and the most cautious, typically that's when markets and asset prices tend to bottom. And that's certainly what we've seen. So we think there seems to be reasonably likelihood that we have passed peak fear. But there's a lot of uncertainty and there's a lot of challenges ahead of us. And we're going to try to talk to you about how we see them and how we plan on navigating them. So our roadmap for today, really it's going to be about something very important that one almost has to separate itself from. If you think about an analogy of a frog in a boiling water, you almost got to step back a bit. We think looking at the big cycles here can be very informative. And we think we're at a juncture right now where thinking about these type of longer term cycles is going to be very, very beneficial in terms of constructing investment portfolios. So we're going to talk about that. And then we're going to make it very specific. We're going to look at where the opportunities are and maybe where some of the risks are as well. And finally, we'll make it even more pragmatic and look at our portfolios and how we've tried to process that and assemble portfolios that bring it all together. So a great place to start, and I know it's already February, but some of you probably just come back from holiday, maybe some of you were on the beach. So these images are probably making you wish we could go back and regretting having come back to work. Think about these two scenarios here. On the one side, you've got a boat that looks like there's a bit of a party going on. It looks reasonably crowded. And think about a story where it's a great party. It gets better and better and better. The people who go and tell other people how amazing it was. There's a lot of liquidity at this party, a lot of daiquiris and mojitos and margaritas and coronas and bubbles and whatever it is that you fancy. And this party is great. Seas are flat, sun is shining, there's great people, everyone's good looking somehow, and this party is going in full flight. Now, there's a very important analogy here about what we've seen in the last 10 years. I think we've seen themes of reasonably stable markets, stable geopolitics for a long time now. The US, in particular, has really driven a resurgence in very strong equity market returns, and as we'll see later, very driven by actually quite a narrow part of the market. But it's been a great time. So interest rates have been low, the price of money has been free, and as a result, asset prices have actually, broadly speaking, been going one direction. It's been going up. It's been a very favorable environment. We've even got to a point now where this party is accelerated to a real bash, right? I mean, a couple of years ago, I'm sure you all remember, we had Zoom. Great product, but I'm not sure it's worth more than Exxon. And yet that's what the market said. The market had the market cap of Zoom being more than Exxon in 2020. And that's, as you all know, is completely reversed now. But I think there's an insight there in terms of what the market psychology was at the time. We had NFTs and crypto millionaires being made almost every week. We had quality and growth being the only game in town. That was the place to be. If you didn't have quality and growth, particularly US companies, offshore, that you didn't have it. It wasn't where it was. And I think what we're seeing now, and last year I think was a case in point, is these waves are starting to get a bit choppy. Okay, I think the weather is starting to gather. You've got some dark clouds on the horizon. I think some of the people on the boat are nervously eyeing life jackets. There's probably not enough life jackets. There's too many people on that boat and not enough alternatives. There's not enough lifeboats or life jackets. It's a Titanic situation, potentially. And I think this is a very, very important analogy about where we stand today. When we look at markets, we see immense crowding in what's worked in the last 10 years. That's very understandable. That's how human psychology works. That's how markets have always worked for hundreds of years. But there's a danger in that, is that those cycles don't last forever. And when you have such a concentration of crowding on the one side, there's going to be disruptions as those things normalize. So the good news here is that we think there are alternatives. There's good old-fashioned investing, the old-fashioned way of doing things, and we're going to take you through some of the ways that we're thinking through this. So a good place to really bring this home is to look at this great chart from Gavekal. And what they do is they look at the top 10 largest companies by market cap by each decade. And really interestingly, every decade there seems to be this theme that really draws these concepts together, these stocks together. In the 1980s, it was about peak oil. We were never going to have enough oil again. It's quite interesting. I mean, if we move back there again, that could be quite interesting. 1990s was actually very remarkable and very unique. Japan was going to take over the world. It's bizarre to think of now, but the top companies in the world in those days were Japanese companies. That, as you know, that bubble crashed spectacularly, and many of those companies have yet to recover, almost 30 years later. 2000s, I think there's a theme that actually feels very familiar. It's the TMT bubble. I think I won't go into that too much. I think a lot of analogies with what we've seen in the last 10 years. And then the 2020s, we had China and emerging markets and commodities and materials really taking over the world. And again, a bit of a revenge of the old economy stocks. And then finally, the last decade, only tech can deliver growth. Now, what's really interesting is that a couple of points here. One is there's always change. Change is the only constant, okay? And the other interesting thing is that bear markets always seem to mark the transition. There's always a bit of painful normalization that marks a transition from one regime or one capital cycle to the next. And we just noted those there for you at the bottom. More recently, we've had the COVID crash and then the 2022 bear market, which we think has accelerated and set the seeds for a new cycle. Now, we don't know what the next top 10 is going to be in 2029 or 2030. That's going to be our job. We're going to try to figure it out. We've got a couple of interesting ideas, which we'll share with you. But I think time will tell. But what we're reasonably certain about, and I'm going to take you through why we think that, it's very, very unlikely that it's going to be the exact same companies that outperformed in 2021. Now, why does this happen? Why are there these cycles, and why do they change? Why is it just never constant? So, very simplistically, but this is broadly how it happens, and it's a function of human psychology and where money goes. Every cycle starts with a kernel of truth. There's always a bit of truth. These things aren't made up, they're real when they begin. And the early adopters find them, they make money, they're glamorized, they get validated. These type of stocks become bigger and bigger in the indices, passive flows move there. Eventually it actually becomes quite risky for asset managers not to own them, okay, because then they look different from everybody else. And then eventually it gets to a point where basically the fundamentals run out, but the momentum overshoots, and that's another constant that we always see. There's always an overshoot element, a euphoria that happens. And it's that speculative phase. And that followed by that is painful normalization, which I think we're starting to feel last year. We're in the middle of perhaps a bit of a relief there. I think if we think of the last month, we would argue that's probably something that's very common that you see in these big trends. You see these little relief rallies along the way. We'd be a little bit cautious about expecting that to continue for too long. And then ultimately the next cycle commences. And we see good signs that the next cycle has commenced and is presenting really exciting investment opportunities. So let me show you two very interesting case studies here of how this works in practice. And the best way to track this is to root it in true hard data and money. And what we track here is capital expenditure. So it's the amount of money that these sectors spend in future capacity. It's a signal of how confident they are of future demand. And it's the capital base that they're going to hope to earn a return on in the future. What you can see is the energy majors had their beautiful decade, as we saw a couple of slides ago, in the 2010s. And their capital budgets increased from 30 billion to about 160 billion. Peaked, and in hindsight, they massively overinvested. They got ahead of themselves. I think they extrapolated Chinese growth forever. They built too many pipelines, dug too many holes in the ground, pumped too much oil. And the next 10 years were brutal for any oil and gas investor, as we all know. And as a result, as you can see, what happens very naturally is that capital budgeting gets slashed. They invest less, they get more pessimistic, and that's continued. Even post-COVID, despite the fact that we've got an energy crisis on our hands because of what's happening in Russia and Ukraine, these companies are still not investing anywhere close to where they were investing at the peak. So what does that do? It sets the scene for really, really good returns because there's an underinvestment. So we're quite excited about this part of the market, and a couple of these companies are represented in our funds. Now let's contrast that with the heroes of the last decade, the internet giants. In almost every single global portfolio out there, certainly money cap weighted, you'll find at least one of these names. And look at their cycles. That's actually even more remarkable than the energy one. In 2009, these companies weren't spending very much. I mean, $19 billion is a lot. We've combined CapEx and R&D there. So for these companies, remember, they're not building factories. These are people that they're hiring. They're employing software engineers and product managers and baristas, as we all know. And that's their CapEx and R&D budget, okay? And that went up tenfold in 10 years. I mean, that is an acceleration that is absolutely remarkable, to 180 billion. So more than what we saw out of some of the largest companies in the world, energy companies in the world, some of the most important companies to the future and sustenance of human activity on this planet. In 10 years, this sector superseded that in terms of how much they were spending. Now what staggered me when I saw this was what happened in the next 3 years. During COVID, 3 short years, COVID, everyone's sitting at home, these companies get a massive boost to short-term demand, and they do it again. They doubled again, from 184 billion to $350 billion. And we all know some of the areas that they've gone into. Reasonably speculative areas like the metaverse and self-driving drones and a whole bunch of other things. Now, some of these will be productive investments, but a lot of them won't be. And a lot of them are just very expensive, underutilized and unproductive software engineers and project managers. And looking forward, the big job we've got is to try and ascertain is, are we at the peak? Because if we see this capital cycle peaking and normalizing, it's normally a very good evidence that we're in a new regime and there's going to be a new cycle that's going to drive the future leaders of the equity market. Now, how do we track that more recently? For the tech sector, one of the easiest ways of doing this is looking at employees, because employees are the CapEx budget. And again, you can see here the remarkable growth from 168,000 people, software engineers and baristas, to 1.1 million, and then in 3 short years, 2.2 million people. Remarkable. And I think you've all seen the same headlines as we have. So companies are recognizing, they're admitting now that they're overinvested, they got ahead of their demand curves, they've got too much capacity, too much supply in the system, and they need to normalize. And they're going through quite a painful process, as you can see on some of those charts. So putting it all together, what does it mean? Very simply, we think it means that a new cycle has very likely commenced. We don't know for sure, it doesn't have a 100% probability attached to it, but we would argue it's got a very large probability. And it has radical implications on where risks and where opportunities will be in the years ahead in investment markets. So this is a snapshot of what we think this means. What you'll see is, on the one side, it'll be those areas that did incredibly well the last 10 years, we think are very likely to disappoint. They're still very expensive, there's still a large degree of over-ownership, they're very crowded, almost everybody's in them, and there's still a lot of speculative growth priced into their asset prices. and earnings, and as we saw in the capital cycle, is very, very extended. So we think those areas are likely to disappoint, and we think there are better opportunities at much lower risk with a lot more opportunity ahead of them. And myself and Dirk will unpack some of those for you in the slides to come. So the one thing I'll just touch on here is this has just been a snapshot of some of the research and the work and the thinking that our team does. I would really encourage you, if you're not on our distribution list already, we do some really excellent writing. My colleagues do some, in particular, do some excellent writing on some of these themes, some of these research topics. We're able to go into them in a lot more detail, show a lot more evidence, build out the arguments a lot more. So if this conversation has been interesting to you, check that out. Get on our distribution list. We've got our next angles and perspectives coming out in the next couple of weeks, which deals with a lot of these matters. So hopefully they'll be useful to you and perhaps your clients as well. Okay, so we think a new cycle has commenced. What does that mean? Where are the opportunities? This is something we've been talking about for a while now, and it sounds obvious when you say it, but there's a very important point underneath here. We think the cheaper stocks are still where the value is. And what this chart from AQR shows you is over a long period of time, they adjust for industry and countries, so it's a nice representation. They show you the gap between the most expensive parts of the market and the cheapest parts of the market. And 0 is that average gap, because there is always a gap, and it's healthy to have a gap. But what you see is every now and then you get these blow-offs. They often come after a cycle or a regime of a lot of speculative activity or euphoria. And as we've shown you, we think we've just come out of one. We think that's what the evidence shows. So what that means is that expensive companies are too expensive and cheap companies are too cheap. And there's an opportunity in that. And we saw that last year starting to unwind. So last year, some of the biggest pain that we felt in the markets was in the most speculative areas. And what's really interesting here is it's hardly a blip on that long-term chart. So we think the story, as with all cycles, has the potential to last many years. It doesn't just happen in a year and then we're back. We're back on the wagon again. So we think we're in the early stages of this, and I think this should underpin a big part of investor portfolios. And I think a nice way of just illustrating this is that there's actually an anomaly out there at the moment. Investors who are willing to invest in areas that are less crowded and maybe out of favor don't have to compromise too much on growth or quality, and yet they're getting a massive, massive price discount. And this is a great way of just showing that. So here we've got 3 companies. 2 of them in particular are very well owned, B and C, in a lot of quality manager portfolios, growth manager portfolios, and they are exceptional companies. But they're very, very expensive. They price in a lot of future growth. They trade at, as you can see there, very high earnings multiples. And the growth prospects, while resilient and okay, are not particularly impressive. In fact, we're in a world where inflation, is bouncing around between, call it 4% and 8%. You're not really getting a hell of a lot of inflation-beating growth from these companies. And they've underperformed last year. And even after the underperformance, they're still expensive. Whereas company A is quite unique. It started off reasonably cheap, 9 times. It's got better earnings prospects than the other 2. And it did very well last year, up a third in dollars. And it's halved in its valuation. So its valuation's got twice as attractive. You're only paying for the next 5 years of earnings relative to the 20s and the 30s. So these companies are Shell, Nestle, and Moody's. And I think this is symptomatic of what we're saying. There is a massive opportunity here. Shell is not glamorous. There's ESG concerns. It's done poorly for the last decade. Nestle and Moody's had a great decade. And I think that's still reflected. Investors are extrapolating that to continue. And I think there's an opportunity. We're still early enough in the cycle for investors to take advantage of that. That's not always going to be the case. At some point, the cycle's going to flip around. But for now, we think there's a lot of opportunity in Shell, and that's in all of our portfolios. The other very important point is that we think US assets look incredibly risky to us. The US has been the place to be. Warren Buffett's backyard, and it's had a hell of a run. But what you've seen now is it's outperformed the rest of the world equities by so much that the US on its own is almost 70% of the MSCI world. So the US, one country, is 70% of global markets. And what we see with history is that those levels of extreme concentration, while they happen from time to time, are never permanent. There's always a normalization. And we would favor places that are outside of the US, that are much less popular, where valuations and earnings levels are much lower, and we're able to buy plenty of really good companies there. So we favor places like the UK and Europe, even Japan. Emerging markets, we think, had a bit of a tough decade, the last decade, and we think particularly commodity exporting emerging markets could do a lot better in the decade ahead of us. And then within emerging markets, something that sounds completely bizarre to all of us sitting in this room with load shedding. Some of you probably didn't have water this morning. You know, it's a very tough place to be. We still think South Africa deserves a place in your portfolio. And I'm going to leave it to Dirk to take over from me and tell you why.
Thanks, Justin. Morning, everyone. Thanks for attending today. So meet Stoffel, or for those who haven't met him. I'd encourage everyone to have a look at this BBC documentary. It's very heartwarming. It's a creature of South African wildlife that is incredibly resilient. And if you look at the documentary, he's been put in some very sticky, difficult, challenging situations, but he always prevails. He always makes a plan. So in Afrikaans, that's my mother tongue, we have a saying, "Sutai soos 'n ratel." It just means Stoffel is actually a very good mascot for the companies that has been surviving a very, very difficult backdrop over the last decade in South Africa. As Justin has alluded to, you might think that you're quite crazy, investing in South Africa. We're constantly bombarded with negativity. The news flow seems to be getting worse and worse and worse. But yeah, that needs to be acknowledged. But also quite interesting, just from an investment point of view, the companies, this dynamic has been going on for over a decade. And the companies has managed to survive, have proven themselves to be very resilient. They've showed that they are able to make a plan, they've right-sized their cost base, eked out any efficiency that was available to them. That speaks to a key theme of our presentation today as well. The companies that's managed to survive, there are a lot of companies that actually exited the market, and we have very little investment going in. So from a capital cycle point of view, there's also very little competition. And as soon as some of the elements of today's environment start to normalize, we think that's a very favorable backdrop for these companies to thrive. But very importantly, we're also finding that the share prices have baked in a lot of bad news. We've been quite selective in terms of where we are accessing this opportunity, but we're most definitely finding areas of the South African market where we think the market is overly excessive in terms of baking in bad news. Then there are pockets of growth available. One of our key holdings, Discovery, is testament to this. They've been investing for growth over the years, but it's not been visible as yet. But we expect some good growth to come from them and some of our other holdings as well. And then just finally, the delisting trend is quite indicative of where we are in the cycle. Typically, when you find a stock exchange having the delistings that we've seen either by virtue of M&A, the M&A suggests that the company has become cheap enough that even a foreign company, looking at this very tough backdrop in macro, can still say this is adequate for us in terms of a return point of view. And then the delistings also signal there's just no capital or investment coming into the market. Very interesting. Last year was probably one of the toughest years that we've had globally. Just looking at the performance of the MSCI World, it was actually down a little bit more in dollar terms, but this is the Rand performance. The Aussie was flat. And I think maybe I'll just touch again on the recession slide, or the fears about recession that Justin pointed out earlier in his presentation. So there's always a big danger, even if you know how the markets or the backdrop will unfold over the next year. It's always quite difficult to see or to have a very good sense of what parts of the market would perform well. Now, if you told me a year ago that the MSCI World would have been, one of the worst years on record, you probably would have think, geez, it's not a good idea being exposed to mid or small cap companies. But completely against the run of play, they were a very good source of alpha for our clients and our funds. A couple of examples there. We've got Grindrod Shipping, HCI, and the Grindrod, the conglomerate. On average, they were up more than 100% last year. And then just as a reminder, given our relative size to competitors, we are still able to access these opportunities in a meaningful way for our clients and our portfolios. And there's just a little snapshot of the current opportunities that we are accessing. Now, looking at the 10-year government bond yield in South Africa, we are now presented with an exceptional entry point. The markets have come down a little bit, but for this presentation, it still fits the purpose. We have very high yields around 11%. And it's very interesting to observe. It's as pessimistic as a gauge, as it were, when we had the COVID crash during April 2020. So we do think there's a lot of pessimism baked into this market. And why are we saying highly asymmetric equity-like return potential? So we're not arguing against a country-specific risk premium, but we do think it's quite excessive, just what we are observing today. There's no reason why the bond yields could be back at 9%. That still adequately reflects quite a bit of country-specific risks. And should we see those yields again in 1 year's time, you could easily get a return from the government bond market north of 20% for very low levels of risk. Now, if you look at this chart, you might tell yourself, geez, it's probably been a good idea to have avoided this market completely over the last decade. But what is surprising, we've had inflation, averaging below 5% over this period. So there was always a reasonable real yield embedded in our bond market. And when you have that dynamic, it's a feature that can act as anti-gravity. So this is the Orbi total return chart referenced back to 2010 as a start, and that's against CPI. What is quite amazing, there's been a lot thrown at this market. We've just highlighted there in red some of the crises that has unfolded over the last decade. But these are temporary setbacks. And given the high real yields available on our market, it has acted as reverse gravity. So despite the negativity, despite the very difficult backdrop, investors in South Africa, they've enjoyed inflation-beating returns of 3% from investing in our market over the last 12 years. And as a reminder, yields are now at 11%. So it doesn't mean that the performance is done. You can actually expect even better real yield returns over the next decade. Now, a very stark contrast to this is the US bond market. This has always been the safe haven darling of the markets. And I've been scratching my head since 2015 at least from this market. The market has performed by virtue of negative real yields becoming everly more negative. And the average US investor become poorer investing in their bond markets, trailing inflation by about 1%. Okay, so that's a little bit, we've given you some idea in terms of where we're finding opportunities, and let's make it a bit tangible in terms of what we are doing. So just before I move into that, a very quick reminder in terms of our product offering. So at PSG, we do offer a very simple product range, but we have very deep capabilities. We have about 20 investment professionals looking at all the various different asset classes. But most importantly, we apply a single philosophy, which is, as you would know by now, our 3M investment process. So just starting off with income funds, we've been investing in fixed income since 2006, but we're particularly proud of the capabilities that we've built over the last decade. And not that it's an overly particular focus for us, but we recently got some very good acknowledgement from the Raging Bull Awards. Our PSG Income Fund won an award in the fixed income short-term category for best risk-adjusted returns on a 5-year basis. Equity funds, we've been doing this since 2002, and we've got a good long track record that speaks to this. And then very importantly, global funds. Some of you might not know, but we've been investing on a bottom-up basis in global equity since 2008. And if you look at the track record from the PSG Global Equity Fund and the PSG Global Flexible Fund, we think we've dispelled the narrative that it isn't possible to invest successfully globally from South Africa. What's very important, Regulatory 28 is giving us more leeway now to invest up to 45% offshore, and we think this is a very important capability to have in-house. We've also had a look at some global active managers, and what we are observing, even they are saying active on the tin, they aren't very differentiated from the markets. And the environment we're heading into, we think this is very important capability to be truly differentiated when it comes to active global investing. And then just quickly, where it all comes together, this is our multi-asset funds. All our key core capabilities are represented in the multi-asset funds. And this is where me and Justin, our responsibility sits in the PSG Balance Fund and the PSG Stable Fund. So for the remainder of the presentation, I'll just focus on the PSG Balance Fund as I unpack where we are positioned, as it is a good representation of all our core capabilities. I don't want to spend too much time on this slide. It's just a very quick snapshot of our performance track record over time. On the top, you have from 1 month, 6 months, all the way to 7 years, and since inception. And down on the y-axis to the left is just the full product suite. But what we do see, we have some pleasing progress. The green and the grey bars are suggestive of first and second quartile performance over time. But we're well aware this is backward looking, but some good progress. And just to emphasize again, the focus for us is on the years ahead. So this is the PSG Balance Fund. This is typically the summary that you would see in the fact sheet, but it's not always quite tangible in terms of the aggregate bets that we are taking. So I won't spend too much time on this. I'll give you, in the next slide, just a different way of how we are slicing the fund in different buckets. All of these buckets are quite distinct and different from each other, and hopefully it gives you a sense in terms of our diversification and key exposures. All right. The first category is what we call underappreciated quality. We have about 26% of the fund exposed in this area. Now, these are companies where we think the market is underappreciating either a good growth prospects that's not yet visible, or a temporary issue that a company maybe is dealing with, and the market is being overly fearful. I'll give a couple of anecdotes as I go along as well. Prudential is a very good and interesting case study. It's a UK-listed financial company, but most of its business is being done in Asia, notably in Singapore and Hong Kong. And what we find, UK financials are extremely out of favor, and with the recent dynamic of China closing its borders with Hong Kong, we have a bit of a growth slowdown, and we think the market is being excessively pessimistic on actually which is a very high-quality financial franchise. The next category, which we've touched on quite a bit in this presentation, is the supply constraints real assets. We think over the last decade, the market is truly underinvested in the real parts of the economy. And despite all of that, we still see very much a supply discipline from the companies here, and we think that bodes very well for their return profiles and profitability. Quick case study, Noble. This is a deep-sea oil drilling rig company. And we know the acute situation globally with energy. We think those are very scarce assets that has huge relevance over the next decade at least. Then mid-cap SA, here we've got about 16%. As we've touched on, this is an area that's quite neglected and very underrepresented in mainstream portfolios. And given our size, we are still taking advantage of this segment of the market. And going back to Stoffel, these companies haven't been asleep. They've been working very hard in the background, making sure they are resilient, doing what they can. Sun International is a very interesting example. They've been facing a trifecta of very difficult circumstances with poor confidence, below potential GDP growth, and then tourism and leisure has really taken a beating during the COVID period and yet to be recovered. During that time, they've rationalized their cost base, taken a lot of cost out of their business, And given that there's such an uncovered part of the market, we think that's a good example of a company that can really surprise the market once volumes normalize. Cheap financials. This is a category which has been basically the anti-beneficiaries of the last decade. Low interest rates, low growth. It's not a good environment for these companies, and the market has overly discounted that into perpetuity. And we're finding some very good, high-quality, cheap opportunities there. Amazon is an interesting case study, a UK REIT with some exposure in France as well. And it's been a dismal time for UK asset valuations. Rentals have been rebased. But we're starting to see those dynamics inflect, but the market is still taking a very grim view on the UK REIT market. And then just finally, we have, as earlier suggested, there's a real good opportunity in South African fixed income. We've got about a 24% representation here in the balance fund. Most of the representation is through South African government nominal bonds, but we do think inflation-linked bonds play an excellent all-weather role in portfolios. And you'll also see on the fact sheet we are exposed to Eskom, but again, we just want to emphasize we're only taking the government-guaranteed risk on the Eskom balance sheet. All right, so just back to the boats. And again, to summarize, we think that the market is maybe still on that party boat in terms of the last cycle. Things that has worked well, we all know beta, index, and passive. And as the market is going to try and sort of rebalance or reassess a new equilibrium, as Charles showed in his slide, that there are instances where it takes a long time for the market to find the new equilibrium. The returns are typically quite dismal during that phase of the market. Tech, US, large cap, quality growth, these things have already pointed out, and it was a great time for developed world bonds and developed world FX. So the next cycle, we're encouraging investors to have this new sort of active and open mind and just consider that things could be different. To be a differentiated active manager, we think is quite an exciting place to be. There's some very good opportunities in the real economy outside of the US. I think there's a really good potential period ahead for emerging markets, and especially away from the larger segments of the markets. And we're finding great opportunities where it's uncrowded. If you're willing to go where it's a little bit discomfort, there's some very good opportunities. And then, again, the rand might strengthen as investors start to gravitate towards the real yield opportunity in South African bonds. I'm just going to leave you with some key messages here up on the screen. Just from a personal point of view, we're quite excited about the future, but we do take that with a huge dose of nobleness. We know the markets can surprise us most of the time, but we do look forward in the years ahead. So thanks, everyone. Thanks for attending today. We really appreciate it. Thanks for coming.